Okay, so you may have read the book Rich Dad Poor Dad, and the book is pretty simple. It talks about Rich Dad explaining to his son that you need to purchase assets that allow you to make lifestyle choices. Now, that's all well and good because it teaches you about investments and the idea that assets that produce income can allow you to live the lifestyle that you want. But at the same time, it doesn't talk about the actual expenses that you face along the way. And that's where that becomes an issue for a lot of people. The concept of the book, it talks about buying a property that you can essentially rent out, and after paying all your expenses, the balance that you get, which is your essential profit margin, you could use for anything that you want, to buy a luxury item and even to purchase more assets. But they don't discuss the actual issues that you face, which is number one, every market is different, but two, the other hidden costs that incur within this process. And thirdly, it's not viable for everyone, even if you earn a salary that's going to be able to get you that first investment property. Now, the book also talks about poor dad saying that you go to college, get a job, and that's pretty much it, right? You work till retirement. But not everybody has that luxury of just getting a load of cash on their lap to be able to make investments. So some people have to work and build up capital to be able to invest. So I'm going to highlight some of these issues that they do face along this process and what they don't really tell you, because as a property practitioner that's been in this business for over a decade and been active in investments, I can tell you one thing that they don't teach you in the little nitty-gritty stuff, which is so important, because as much as real estate is a solid investment, you need to know your costs involved so that you can be prepared for this. So let's take the concept of an investment property, for example. So let's just say we're talking in the South African market, anywhere in Johannesburg, you could pick up a property around 900,000, right? An apartment, be good. So if you purchase this property for 900,000, and assuming you get a bond at a 10% interest rate, which is fairly high, but we're going to use 10% just for the purposes of this video, you're going to be looking at a repayment of approximately 9,000 a month, okay, for a 20-year period. And let's assume that in this property, it's a complex state where you've got to pay levies, which is maybe an additional 1,000 and 1,200, and rates, which is maybe 1,000. Then there's the other factors, obviously, which is lights and water, which your tenant will be liable for, that you'll have in an agreement, and maybe like insurance aspects and things like that. But let's just say, for the purposes of this video, you're paying 9,000, you're paying 1,000 and 1,200. That means 11,200 is your actual cost on a monthly basis for this property. Now, by understanding this cost, we could say, well, I could rent it out for 15,000, which would cover all of those costs and give me a profit. And that's well and good. But what you need to understand, as much as you want to maybe rent it out at a high amount, there's the possibility that that market does not allow you to rent or to rent it out at that specific price point. So what it means is that, picture different areas will have certain thresholds for rentals, right? You'd see in a certain area, maybe it's quite high, in certain areas it's specifically low. And much like the property prices, certain areas are higher than others. The rental prices also differ in those areas. So if you're in an area that you cannot actually command that high price for rentals, you're stuck with the property where you're not going to be able to get that high rental, because this is the mindset of most people. It's like, if I had to spend 15,000 on a property that you purchased for 9,000, and if I could actively spend 15,000 and that area does not command 15,000, I could take 15,000 to another area that's probably better, get some better amenities, better location. And that's how people tend to think on that. It's not always about being close to work, but also it's about the area and convenience of things that reduces traveling and all of the other aspects of people. So If you come into that scenario and now you say to yourself, okay, I can't rent it out for 15,000, but even 11,200 is not viable for my market because my market only looks at about 10,000, and you put it on rent, you're actually running at a loss then in that regard. And that's what the concept of Rich Dad Poor Dad doesn't really speak about these things, because not every market allows you to rent out for a profit. Sometimes there's a lot of people that take a loss on their rental, and they take a major loss or they take a minor loss, but they're not able to produce that said profit margin on that specific property. Now, how do you go about this? How do you look at this process and say to myself, well, I want to invest and I want to get profit. What do I do in this scenario? Well, what you need to really look at is purchasing in possibly the lower areas where it's more affordable for everyone. When I mean lower areas, lower income areas, you'd see a lot of the time that if you purchase property in those areas, and it doesn't necessarily mean it has to be bad areas. I mean, it's just areas that may be on the outskirts. And what I've seen is that if you purchase in these areas, you could potentially pick up properties much cheaper, and then you would be able to rent these properties out with the idea of being within market value. So let's take an example, right? Say you were to take maybe an area like Boksburg West, or the Boksburg region, right, in Johannesburg, and you pick up a property about 350, and say the market in that area is about 3,500 to 4,500 in terms of rental. Okay, if you were to pick up the property, put your deposit down and whatever, and reduce your bond, where you're probably paying now 3,000, so 350, put 50,000 deposit, you're spending about 3,000 a month. Levies is maybe 300, lights and water obviously, and then that's going to be for the account of the prospective tenant. You could potentially, after renting out for maybe 4 to 4.5, see a little bit of profit. And at the same time, while it's not big massive profits that you may want on more of the middle kind of income suburbs, the idea behind that is that you're purchasing real estate that's cheaper, that you could potentially free off faster, and at the same time, once it's freed off, it's giving you income that you're able to utilize. Now, that's the concept in South Africa that we face, is that many people want to go for more of the mid-income properties without having substantial money put in as a deposit to be able to reduce your mortgage repayments, where you get to the point where you could then say, if I bought the property for 900,000 and I put in 400,000 and I get a bond for the remaining 500,000, I would then just be paying 5,000 a month plus utilities and the levies, and then I could actually rent it out for 10,000 and then make 2 to 3,000 profit on that property. But not everybody has that opportunity. Not everybody has a big amount of cash. Some people just want to start off. So if you're the type of person that's just starting off in the real estate investment sector, that's what essentially you want to look at. And from there, it's a process where you have to wait and you build slowly on. Yeah, think about it if it's something that you really want to get into, because by explaining the details and putting those details into account, you'd be able to make a much informed decision. And to be honest, real estate is the safest option and one of those investments that will really help you in the long run. I'll see you in the next video.